Governor, we're live.
Good morning, everyone, and I'm going to call the emergency board meeting to order. The materials to follow along to this meeting may be found online at aoa.vermont.gov/revenue. We'll first take up agenda item number 1, the private activity bond allocations for the calendar year 2025. I'd invite Scott Baker up to present from the Treasurer's office. Scott.
Good morning. So each year, states are allocated a certain amount of private activity bond volume cap, and there are 4 agencies that can issue private activity bonds: VITA, Vermont Economic Development Authority, Vermont Student Assistance Corps, Vermont Housing Finance Agency, and the Vermont Bond Bank. It's based on a per capita amount, but there is a minimum amount. So per state, so Vermont gets an extraordinarily high amount. The amount for 2025 was $388,780,000. And at the January meeting, the E-Board allocated $60 million of that to VITA, $30 million to the bond bank, and the rest to contingency. We've talked to the 4 agencies. They're not recommending any changes to this point. But per statute, the E-Board can designate the governor the authority to reallocate that at the end of the year. And the HFA and VSAT generally get the remainder split. They're for 3 years. So whatever they're issuing, they're using full volume cap. So this way we have, use as much of it as possible. So there is a motion. The board, I'm going to read the motion. Yeah, so it's basically for the E-Board to empower the governor to allocate between December 20th and the end of the calendar year the authority to reallocate it, and that we will work with the agencies and recommend that we do that. So.
Any questions for Scott?
Thanks.
Okay. Well, I would ask for a motion as follows. To assign or reallocate any unused portion of Vermont's calendar year 2025 private activity bonds as explained in item number 1. So is there a second? There's a second. Any further discussion? All those in favor, signify by saying aye.
Aye.
All opposed? The ayes have it, and you've approved agenda item number 1. Thank you very much, Scott.
Thank you.
So we'll move on to agenda item number 2, the year-end report on the state's Medicaid program. I'd like to invite Ellen up in the Joint Fiscal Office to present the report.
Morning.
Good morning.
For the record, Nolan Langland with Fiscal Office. Just going to provide some high-level highlights of the Medicaid year-end report. As you know, this annual process required by statute. There's no action required from July E-Board, so there's no motion for today. Total Medicaid and Medicaid-related expenditures for fiscal year 25 total $2.45 billion. This is a 5.4% increase over fiscal year 24. Overall administration was about 7%, which is consistent with previous fiscal years. AHS will carry forward $12.6 million of unexpended general fund for fiscal year 26. Regarding caseloads for fiscal year 25 tracked pretty close to projections. The overall post-pandemic trend of decreasing enrollment continued in almost every eligibility group. Overall enrollment in Medicaid as the primary source decreased by roughly 12,000 people. That's 8%. Biggest decrease was in our childless adults, which is one of our expansion populations. That was about 6,000 people with a 15% reduction. The number of people receiving cost sharing reduction in Vermont Health Connect increased by almost 30% from roughly 3,000 to 2,200 people. The big exceptions in the enrollment decreases was the CHIP, which saw an 18% increase in about 817 kids, for a total of almost 5,300. And in our age blind disabled, we saw a more modest 4% increase, about 286 people. Regarding our healthcare revenues, these include cigarette and tobacco taxes, healthcare claims tax, the employer assessment, and provider taxes. That came in about 1.1 million over projections. Overall, these specific revenues, and as you know, they all go into the general fund now, but overall, these revenues increased 7% over fiscal year 24. Not surprisingly, most of this is driven by the hospital provider tax, which increased by almost $20 million to a total of $212 million. Claims assessment came in on target, and cigarette and tobacco came in just slightly above. Looking ahead, first, the good news, FMAP is once again expected to move in a positive direction for the third year in a row. That's going to be about $16 million to the good. However, FFIS preliminary projections suggest that that trend may reverse in the future, going forward in 27, 28. So, now the bad news. As you know, the federal reconciliation bill includes a lot of provisions that significantly impact Vermonters. Specific to those programs, it will result in a loss of health insurance coverage for thousands of Vermonters, a loss of federal financial participation and investment in Vermont's healthcare system in the form of federal dollars, and increases in administrative burdens for Medicaid beneficiaries, providers, and particularly state staff, as well as our IT and our staffing to manage a lot of those administrative burdens from the bills. Looking forward, specifically at healthcare revenue, the biggest hit from the bill will be in the provider tax, the hospital provider tax specifically. That will hit in October 27, which is fiscal year 28. The other provider taxes will not be impacted. The hospital provider tax is actually exempt. And then the annual provider tax is below 3.5% threshold, which will be out to 2032. And as you know, it'll increase by 0.5% between 2028 and 2032. The executive branch and legislative staff will continue to work and follow this and continue to give you guys updates.
Any questions?
Quick question, the 12.6 million that's carried forward, how does that compare to future?
I don't have the answer. The AHS can answer that, but they're not here.
The reduction in caseloads is that following the same trend from that started.
Yeah, you know, I thought it might level out a little, but it's sort of, you know, it's cyclical. I don't think it's too, you know, with the redeterminations coming back, we actually don't even know what the new trends are going to look like because it takes years for that to happen. So I wasn't surprised.
They finished the first round of
Redeterminations have been done since I think 23.
Okay.
Sometime in calendar year 23. So, but I think what that new world looks like in terms of usually it takes 2 or 3 years of us to have like a normal trend to get a sense of is that normal or is this something to be concerned about?
I know something that we've been working on is trying to get a good sense of how the Medicaid reductions will impact us. And it's not going to be immediate. It's going to be over the next 3 years. Same with health insurance and so forth. They're just trying to get a sense. Are you anywhere near that as well? I mean, they're trying to do the same thing we are.
I think we're doing the same thing you are, and we're working with your teams to figure it out. So I think this will be a team effort.
Any other questions? Thank you. Now we'll take up agenda item number 3, the official state revenue estimate. And that is Jeff Carr and Yvette to present their consensus for that.
Hey, so we are again.
Yes, just seems like it was
This,
that's the guy.
yeah, I guess the story's pretty much the same. We've been a forecast upgrade and general fund, which catches up with the data. I mean,
But it's small. We're across all the funds, we're talking about between 1.5% to 2% per year. And really, this is kind of a steady state forecast, which seems a little bit weird given the tumultuous swings in the last 6 months. But I felt a little bit after hearing the Federal Reserve Board yesterday talk about how they're seeing the economy go, that we're in a similar place. It's, you know, we didn't react like, oh, the sky's falling, you know, with the April crash in the stock market and all that kind of stuff. And we're also not saying nothing's happening. They're elevated risks from things that are really unusual, that we don't know how they're going to play out. And that uncertainty, you know, sometimes the best things to do is just to stand pat. And that's really what we're doing here. And we'll see how some of these things work out. We don't know what the tariff rates are going to end up at. And we don't know, you know, to date, there's been almost no retaliatory action whatsoever. And that's usually the thing that makes a trade war really dangerous, is the back and forth. You saw it a little bit with China at the start, where they were just laying it on at 145%. I'll take 200, you do 300, you know, kind of stuff. And really what it came down to, when China actually said they weren't going to ship rare earth minerals, which are critical in military and high-tech applications in the United States, and we don't have other sources for those. Very quickly, it got rather friendly. All the rates went down. They're still high rates, but the worst of it came down. And I think the hope anyway is that there'll be reasonable sorts of things that get worked out. But the number of workarounds and things in this economy, particularly after the pandemic, where people got very good and very used to figuring out how to do stuff in different countries and different places, and to use technology to find the little, you know, a low cost place that you can export through and the like. We don't know what the ultimate effects will be. We do know that corporations have been swallowing the cost for the most part.
Or their
US
suppliers.
corporations.
Or their suppliers.
Well, the suppliers are in the first 3 months of this through June, picked up about 10% of the tariff costs, but the
Auto companies and
auto companies, the importers, they've been eating, yeah. And I think that's also because they're not sure where they're going to land. They don't want to lose market share. They also don't want to be the target of the administration. Oh, we're raising prices because of this. You saw what happened in Walmart. A few others started to say that. They became big targets. So nobody wants to do that. But what always happens is those that have power will pass prices on. If you have pricing power, you will do that eventually. And so eventually it will be borne by the consumers. But today, there just hasn't been a whole lot of bounce in the numbers, and we'll be watching it. And if it's different, we haven't had a situation where tariffs were this high since the 30s, and it was a different world then. So who knows how it's going to land. Exports are only about 11% of the U.S. Economy, right? So maybe it's not going to be gigantic.
And tariff policy isn't even about economic policy. It's about fentanyl policy. I mean, we're going to put 50% tariffs on Brazil, and we have a trade surplus on the good side. We don't even care about whether or not we have a trade surplus with some of these countries. We're just focusing on one part of it, and now we're going to start eating on India and some of the others. So, I mean, I would layer on top of a high amount of uncertainty around what we're doing. Ambiguity is also there. And I would also even go so far as to say there's paradox. There's inconsistencies in the way it's almost like we're using tariff policy. Now they're talking about using tariff money to pay the cost of the tax reductions, which is the complete antithesis of what they're trying to do, because they're trying to move more production capacity onshore to reduce tariff revenue. So I don't know how that's going to work in the end. And then on top of that, if 6 months ago or a year ago, if I were to sit here and say to you, by the way, we're going to bomb Iran's nuclear facilities, and it's going to look like it was a non-event. I'm astonished at the way things happen. Revenues have held up surprisingly well, but the bullseye is right on personal income tax in this forecast. Everything driving the change in the general fund is in the personal income tax. The last 2 years, it's been the personal income tax and the corporate tax because of the high asset prices and what's driven some receipts in the corporate side of the ledger. But this is purely a function of the personal income tax. Personal income tax gets off track, the forecast is off track because everything else basically has been offsetting, setting aside the transportation fund, which, we tried to true up this time. And I'm going to sit here and I'm going to say, do you know that we were only 1/10 of 1% off on the education fund? I don't get a chance to say that very often, so I wanted to say that in front of everybody. And so really, going forward, we're going to be watching the labor market. We're going to be watching what's going on with asset prices and asset price realizations. I mean, it's amazing to me how much the high asset price environment has caused income events that have worked their way through in the two income taxes.
And the state. So
And
it's the
and
other place to die.
I mean, we had a month of January that was larger than our previous largest year ever in our history in the state. Higher education trust fund that seemed benefit from it, but I mean, it's almost $56 million in state tax receipts. That just tells you where, I mean, there were some years where it was like $2 million, in the not too distant past. And so to see that and to see that, continue is going to be one of the things that we're going to be focused on. So
There are also some discrete events or groups of events in both corporate and PI that occurred in fiscal 25 and that we think are likely to occur in fiscal 26 that we've adjusted the numbers for and built in. They aren't things that, talk about publicly, but they're based on asset price. When asset prices are elevated and there's a transaction, whether it's a capital gains or profit taking, whatever, those values are huge. And so, it wouldn't take a lot of acquisition activity to all of a sudden get, some big flows here and there. So we've adjusted both fiscal 25 and 26 for that. And that explains some of the movement that
that's why you don't see a big drop off in April of next year that we expect relative to what happened in 2023 following the 2022 year. The thing that astounded me about revenues this year, and I would never have come in with a forecast or recommended to him to come in with a forecast where our fiscal year 2025, the category that we count for paid final returns and extension payments would be within $5 million of what it was in 2022, when there was like $13,500 per person in federal pandemic aid coursing through the veins of our economy, the regional economy, and bringing, arming visitors with the capability of coming here and spend. And between 2022 and 2023, there was about a 30% decline in the paid income tax returns, which is about 12 to 15% in this one. I can't remember off the top of my head. So it's half of the drop off that we expected after we had that previous week. And so that's something, and that puts a lot of pressure on the spring filing season. Hopefully we'll see some of it come through in personal income estimates earlier than that, particularly when we get to the fourth quarter. Unfortunately, the fourth quarter estimates come in on January 15th or thereabouts, and we usually put the forecast to bed by then, so we won't have the benefit of that information. But there's going to be an enormous amount of pressure on the next spring's filing season for those events that Tom and I are talking about that we think we know, we think it makes sense, but that's where the risk in the forecast is. So we'll know by the end of April, but that only gives us 2 months left in the fiscal year if things don't work out. So that's the risk when we talk about that risk.
How much of this is due to the economic churn with all the disasters we've had, whether it's the pandemic, 23 flooding, 24 flooding? I mean, there's still money, there's still economic churn because there's things being built. There's that personal income that benefits from some of the disasters, I would imagine.
Yeah, well, the other thing is that there are areas like equity markets that are really absolutely giddy about AI, and the money that, when you look at valuations, of entities that are closely involved in that. They're astronomical. So there are huge, huge bets going on. The build out of the data centers, all the electric energy generation that has to happen to power them. There's enormous flow of resources towards this. If it works out, there could be big productivity gains and then a return on it. But the bets are astronomical. And if they don't do well, sort of like the .com era, it's not saying, oh, the internet wasn't going to be a thing, but they went overboard and then it collapsed. So, you know, there are things like that that are risks too. Those are just massive bets, and valuations could drop quickly in those areas. And some of the companies that have had the greatest appreciation have been doing stuff with AI or leadership positions.
Disaster economics generally says, setting aside the tragedy it is for people that experience it, that with a combination of money that comes in and construction activity it generally lifts the economy to a level that is higher than it would have been without the disaster, at least in the short term in the scheme of things. So there's probably some effect of that going on. And when we were speaking with Doug Farnham, you know, that we've received good reimbursements for the activity and things like that. So obviously, you know, I think that's probably been helpful economically, but just how much it's hard to ease out at this particular point in time because we're not done with it yet.
I think that's the point as well. I mean, we're still not done with the pandemic. In some respect, because we have time to put away.
Right. Which is another reason to keep us on course, you know, and just recognize the elevated level of risk that's out there. And it doesn't look like we're at risk of clawback of any of the federal monies that have been given to us or things like that yet. But you know, who knows what's next?
Quick question.
Yeah, go ahead.
We were talking about asset appreciation, having not read all 872 pages of the big bill, the reconciliation, but did they change, the capital gains tax rates get changed or were those left untouched?
I don't, there's no major change.
No, but there's a proposal that's being floated out there now in Washington. I don't know, you may have seen the story about a week and a half ago. The president even was talking a little bit about indexing capital gains for inflation. As a proposal, I haven't seen anything proposed yet. You know, the ink is barely dry. So we don't know for sure what direction that's going to go. So, you know, not the least of which, if something like that happens, whether we'll have a repeat of 1986. And I still remember 1986.
There is a change in, I think, how small business tax rates are even lower than they already were.
Okay.
I don't know how much that will trickle.
Right,
through.
right.
I don't know how narrow.
That's what I was wondering.
Yeah, the expensing, I think,
Yeah.
Dwarfs that.
Yes, very much so.
but, yeah, you know, it's a long, complex bill. What you're speaking to, Governor, is also though the cash reserves that we have that we're still earning interest on is page 17 of the handout I had, but the interest income forecast were pretty close. We spent a lot of time, you know, doing bottom up modeling and working with the treasurer and the people there to derive those forecasts. The split between the G fund and the E fund was different than we expected, less to the E fund, but so the cash balances are coming down. They have to be. A lot needs to be spent in the next year plus. So that's going to shrink, but that's a lot of dry powder that's there that just hasn't been deployed. And all the states have this, I mean, to varying degrees. And so when you think it's this big in Vermont, if you were to loosely extrapolate that, it's like, you know, 700 billion or so in all the states. And that's just, you know, spending that's got to happen soon. So there are a lot of things like that that are keeping the economy rolling. And, you know, there are pluses going on at the same time. It's just a lot of cross currents now and uncertainty around the whole tariff thing, you know, who it's going to impact. There will be lots of winners and losers, and we'll hear about it. Yeah.
Given that all this instability that you're describing, and then a projection that's essentially steady state. I'm nervous that we are gonna get comfortable with steady state given all the instability, and I just wonder if you have any. I
Yeah.
feel like we should be preparing differently than we would in, say, a steady state that did not have lots of instability
Well,
attached to it.
that's pretty much what the report says.
Yeah,
Don't-
yeah.
Don't get comfortable
Yeah.
with it. And you may have to revisit.
I'm already uncomfortable, but I'm wondering
Yeah.
if you have any ideas
So
for what
wait a
we should be
little
doing
bit,
differently
and-
with our discomfort.
Well, I think that, you know, given the uncertainty, much like the Fed is doing, you have to watch what happens and then react to real world stuff. And if it starts to deteriorate in ways important, for example, you know, the Canadian tariff situation is completely unresolved right now. And that's the most important one for us by far. And it's huge for the United States as a whole. So, you know, who knows what it's going to be, but anyway, I think we may need to revisit some of the stuff. Hopefully not before January, but maybe. And if that happens, okay. We're watching it, and I think that's important to know. But I think otherwise we'd be swinging around in ways that are premature because we really don't know, and that has costs too.
We've done some modeling on the impacts of Canadian tariffs. It was early on when, you know, they first were proposed. And there's a particular vulnerability for us if the tariffs apply to energy. It's because Canadian energy as a percentage of our mix is much higher than a typical state or even the country, when it looks at that. So that's something to keep our eye on. And particularly because it affects the northwest part of the state in particular because of natural gas floods, which is a very important part of our state, economically. But the businesses have been very resilient. And you can see the difference between the larger businesses that have financial capacity to do things like eat tariffs and smaller businesses that don't have the capacity to eat tariffs. And so we've got a situation that's brewing where because of the uncertainty, and we live with uncertainty a lot, probably not quite, this is a different brand of uncertainty than I think that we've dealt with because of the ambiguity associated with it. And so we're kind of looking for, is there a point in time where there's an event or something that happens that kind of breaks something serious and does serious damage? And so
I keep on thinking that point's come, and then it
it
doesn't.
hasn't yet.
Yes, yeah.
It hasn't yet. And I think because there's a natural inclination to understand the hyperbole that comes out of the Washington administration, rather than it's more along the line. I mean, that's how we got terms like taco and all that kind of thing. And so I think until we actually start to see it in the data, it's hard to move off of where we're going because, you know, Tom and I, when we had our conversations, you know, early on, you're saying, well, you know, how many times we've got to be off by 50 million low before the models catch up with everything that's going on. Okay. And so, you know, we think it's beneficial to creep up on it, but we're at the point now where we've had some tariffs in place for a while. We've seen how tariffs have started to impact folks like the car companies. We see how things have started to impact things in the consumer price index in the apparel area and shoes and in some places. We see some of the legacy effects of the COVID inflation that have been impacting insurance, housing and things like that. And, you know, healthcare price increases come through in a lagged effect in the inflation numbers as well. And so we're starting to see those legacy effects start to peter out, and more change in the prices is now going to start to come from more of the more coincidental things. And just the time that we need the inflation numbers to be very good, we find out that 35% of the inflation numbers, because of cuts at the Department of Labor, are imputed. They're not even survey data anymore. You know, I don't know when that point comes. As my kind of feeling is, we've dodged it for another 6 months, maybe a year. But at some point in time, things will start coming through, and we see the world being configured that it won't be the administration's fault, it'll be somebody else's fault, and that's what all the noise around the periphery is being done. And like Tom, I sat there and watched the chair of the Federal Reserve, give his remarks. And I mean, the wait and see approach is probably prudent. The problem is wait and see. If it starts actually showing up, it may already be too late to forestall a significant amount of pain that's going to come. The labor market's still strong, but if you look at the U.S. labor market numbers, most of it was private sector job creation. Basically, was wash. It came from the public sector in the last employment records, and we're still struggling with jobs in our state because we have too many job openings and not enough workers. And if you turn around and look, I've charged my report where I look at construction trades and what percentage of it is immigrant labor and what percentage of it is illegal immigrant labor. I don't know how we're going to do a roof in the state if we get rid of all the illegal immigrant labor, or spackling, or the types of things that need to be done to build the houses that we need to take care of the people that are unhoused and the people that need housing. So it would be an incredibly resilient system, but at some point in time, something's going to break, and then we're going to have to be very deft and quick about how we understand it and everything.
And I think we're all imagining we're probably going to for January. So
We'll see.
Yeah.
We'll see.
Yeah, I think it's important to remember too, with the tariffs and some of the best quantified work on this has been done by a group at Yale called the Budget Lab. And even if you take all the tariffs to date and the things that we think we won on, the long run real GDP in the United States will be about 0.4% lower. This is going out 10, 15 years, just lower than it would otherwise have been, about $150 billion a year. That's not, catastrophic, all the rest, but it's not like winning is getting us something great. Actually, with the tariffs the way they are now, the impact on China's real GDP is less than the negative impact on the United States real GDP long run. And so,
Whether that's good.
Well, it's not so simple as that. And a lot of it is performative. So I think that's important to keep in mind. If countries retaliate, like Canada actually has the worst long-term hit to GDP, but it's in large part because they took retaliatory action. So, you hurt yourself when you retaliate, and if that escalates, everybody ends up just being a whole lot worse off. So the best approach for somebody on the other side is to try to get them as low as you can, because then you'll become a funnel for other countries to go through you. And actually you can end up being so the UK ends up having a positive long-term real GDP impact from the agreement that they got to pay 10%, to accept 10% tariffs.
It's not even a real agreement. It's a framework agreement.
But anyway, it's not always intuitive.
can we hop over the transportation fund?
Yeah. Yes. Motor vehicle purchase and use was the whipsawed in part with some of the tariff stuff. So you got some early buying, and looks like it just sort of collapsed, even though you didn't have a lot of price stuff. So it was in the last quarter, a weird 3 months.
Are you seeing that across the country, or is it just here?
No, it's not like
So it's not like
sales were all over the place like that. And I always scratch my head when I see numbers like that. Like, is there something in the processing that's messed up, or are they going to find that, we forgot to file after the things where they should have been or something? People pre-buying. Well, the pre-buying was happening. We know that was happening, but that happened all over the place. And inventory, it's an equivalent sort of thing as of the inventory buildup too. So you're gonna get a reaction to that. But it was bigger. I mean, they should offset somewhat. Unless at some point there's such uncertainty, people are just saying, I'm waiting. I'm just not gonna do anything until I see where the dust settles. The stock of cars is quite old. So it's not like there's no need.
Inventory for sale is quite low.
Yeah. Prices really haven't started to show up much, and they'll be in new and used at the same time because those valuations are linked. But and they'll seep into insurance prices and auto parts and all that. So all that's gonna come. But yeah, it's hard to know. I mean, the aluminum and steel tariffs were the first ones, and those of course go into vehicles.
But we've seen some
There wasn't
pressure
a lot
on
of price
financing, we've seen some pressure in financing too, the rate's gone up, people are lengthening the term.
Yeah, but they've been high for long, for a while. So that's not like all of a
It
sudden.
didn't happen in the third or the fourth quarter of the
Yeah.
year. And just to see, all I had to do is look at the GDP numbers yesterday. For how imports and exports shifted things. We were negative in the January to March quarter when we were importing a lot, which means that we weren't domestically producing. And then when that importing stopped, it was a big swing in the April to June quarter back in the other direction, and GDP was up. But if you average the two, it was up about 1.2%, which is about half of what the GDP growth rate was nationally last year.
And so do you think the hole that we have is gonna keep getting larger, or do you think it's gonna stay around the size of hole?
Well, we down,
In transportation,
Yeah.
it's gonna stay around the size that it is, because we're assuming there will be price effects when they come. So average car, probably $4,000 to $6,000, something in that range. So that'll be a step up. And, so ownership costs will also be higher. Anyway, all that will work to reduce demand a bit. And I think the uncertainty factor is also a part of it. So it's lowest fiscal 26, 27, and then it picks up. But I think motor vehicle purchase and use is particularly vulnerable because of the way the tariffs come in and the differential rates that end up impacting vehicles in a way that they don't impact everything.
not only that, but sometimes cars that during the course of a single assembly go back and forth across the border multiple times,
Right.
which is also a problem, I think, particularly the cars. And the registration data are funky now. So it's difficult to get a handle on that.
Yeah, your domestic car manufacturers upset with the deal that Japan got because when they add up the tariffs on the stuff that they're doing with partial work done in places that had 25% tariffs, things like that, that the Japanese 15% on everything gives them an advantage over the domestically produced stuff. So, I mean, these production models have been designed to minimize cost given a regime of tariffs and trade agreements that exist. Now, when you throw that up in the air and scatter it all, it's not easy to sort of, okay, we're just going to come back in and sell it this way.
Japan's safe until they become a source of fentanyl in the eyes of others.
And all of that affects the entire country, right?
Yeah.
It still doesn't explain.
Right.
why.
We should see,
And if it's the Northeast region, maybe there's the aging demographic has something to do with it. If you.
but in one
buy,
quarter,
I know.
it was good right up until the,
I really understand why.
yeah, we are too.
New Hampshire, did you look at Hampshire and Maine?
I didn't see their data, but I looked at national data.
Yeah.
Because it should show up nationally. It should, finance rate, availability, inventories, all that. It's good national data on that. And they were purposely not passing the prices through right away. So hard to know.
Can you say of the downgrade, what percentage is purchase and use? Is it all of it, or is it just lion's share?
There was a bit less motor vehicle fee, revenue from the fee increases, so
Fuels just.
that's weaker. Fuels were right on, yeah. Both fuels were right on.
And the other
two-
revenue category was right.
Yeah, I mean, really, one of them.
Really percentage.
Purchasing
Yeah, purchase fees is big, and fees, yeah.
a lesser extent. Because the missing fees was a little bit less than motor vehicle. purchase.
And they're
Your
for growth.
with the ed fund before.
Yes.
Still a lot of money.
It's still a lot of money.
I mean, percentage wise, you're right on, but still a lot of money.
And anything, yeah, can get a lot of money.
I do have a question back on personal income in the general fund. How much of that is assets? Like if we're looking for a sign in the next 6 months, as a downturn in the stock market, is that like the biggest part of that? Would that be?
No, you definitely have people transacting a lot, and sometimes when it goes down, people would be trying to get out, and then they'll have taxable gains because they get out.
Well, if they get
while
out,
they're still a little bit ahead. If they don't, a lot of times they then will wait. It's
Right.
like, why sell for a loss? You know, it's just a paper loss unless you think it's going to keep going. So that's hard to say. No, I'd be more concerned with the slowing in job growth and labor market turning bad and having withholding, the payroll.
That would be the
Yeah,
change.
withholding.
We're not gonna, the high asset price environment is probably gonna stick around longer.
But it's volatile.
Yeah, it
You
is.
know, that's the problem. The high end, you get big events that could be, enormous. And sometimes things like corporate acquisitions come, the money doesn't show up in a corporate profit. Sometimes if it goes to individual owners and they're residents of the state, then it's personal income and it could be estimated or paid. Depends on how their accountants tell them to do it. So,
And estimated sometimes are a good leading indicator of the pains, but sometimes they're not. Because if you adhere to the estimating rules, if you have a big gain and you can wait till April, okay? Then the next year, of course, you're estimating payments go up in your formula.
but we'll know this from tax because if we get bumps, we can say, okay, where is that? What's the derivation of that? And that's what we're trying to identify is what are one-time kind of things and what are things that are like.
I look at the September estimates, as the first indication if there's any change. Because that's when sophisticated taxpayers maybe make a change. And then obviously the year-end estimated payments are a strong indicator of what April's going to do.
So, I wonder if we could talk a little bit more about the potential impacts around immigration and undocumented workers who are, and what's happening with ICE. I mean, I just read the Times yesterday about a Nebraska meatpacking plant that lost over 50% of their employees. And now they're like, we don't even know how we're going to operate. It was all the supervisors or all the people that did the work. It's not like people are lining up to do the work in dairy farms and other places. And so that could affect, I would think, corporate and personal income impact on the job market. You talked about construction and not being able to have people to do the work.
Yeah.
So, I mean, that's what I see as at least blinking yellow, if not outright red at this point.
Yeah. Yeah. And there's some states that are way more exposed to that than Vermont.
Yeah.
But still, it's definitely sectors like agriculture, construction, healthcare is another one. There's a lot of, home health, home health and all that kind of stuff.
Yes.
Actually, numbers in that of foreign-born workers, just the levels, not the share, are highest. But the shares are highest in construction and agriculture.
So that's got to affect our,
Yeah,
Not being Vermont, right?
that and the output will be lower because this is, a big part of the production is how many people do you have and how productive the people. You lose people and
exactly.
it's going to drop.
So that sort of should be maybe some other signal with regard to the labor market.
Yeah,
Just for information on page 25 of my report down in the left-hand corner. There was something published by the National Association of Home Builders, and they looked at the census data. And they looked at the percentage of immigrants in the workforce, and this is in 2023, so it's a little bit old. But plasters, stuccos, 61%, drywall, ceiling installers, 61%, roofers,
Right.
52%.
Nearly 3/4 of all growth in civilian,
Yeah.
has been in foreign-born workers.
Yeah.
Yeah, so
And-
that kind of gives you an idea of this important, and that's healthcare, hospitality, production agriculture, things like that, where the percentages are high.
Right.
So much strangely, I was in Nebraska yesterday. And so I'm wondering if labor markets and sort of checking in on labor markets is the indicator we should be paying attention to. And we have all these layoffs at the federal level with Department of Labor. And I imagine that most immigrants are not going to file for unemployment out of fear. Then is there another labor indicator that you're going to start looking towards that's more reliable?
Well, I mean, unemployment rates are gonna, you will have, one of the reasons unemployment hasn't risen is that you've had the labor force that's been pretty much stagnant. So a lot of labor force growth was in foreign-born
Yeah.
workers. So that's kept the unemployment rate fairly low. So that though is one of the things the Fed mentions all the time in looking at labor markets. So, they're looking at that and looking at inflation, PCE price inflator. And that will determine interest rate changes more than anything. You always look at a multitude of data. We look at quit rates and hiring rates and initial claims for unemployment insurance and duration of unemployment, various things like that to try to get, the best handle on it you can. So there's no one data point that you know, well, that's it, it's matching.
I would add one indicator that I look at. Unfortunately, it's become a little muddled in the last couple of years. Personal income withholding. I mean, that's the money. That's the money that comes in. That's what the employers pay into the state on behalf of their employees. Unfortunately, that signal's become a little muddled by the childcare payer effects because that's paid with every payment, and so we do our best to make adjustments to that going forward. But that's the money, and that's the part of personal income that's basically half of it. So I look at that. I look at revenues every day, and I play around with personal income more than I do any other revenue.
In terms of the undocumented workers, I was in Colorado this past weekend with the National Governors Association. It does seem like there's some hope there in terms of coming to some agreement with like a gift worker program of some sort to broaden that amongst both Republicans and Democrats, at least on the governor's level. And I would assume that their Republican governors are speaking with the administration. So I think there is some hope that they'll come to some resolution on that.
I think there's a hope kind of all the way around some of these policies that are a little more draconian, same with tariffs and things like that. It's like sooner or later, whether it's businessmen or whoever has access to the highest levels there will shake some sense into and say, look, we're closing down factories because, you took half of our workers, we can't replace them. And, that sort of thing. And it seems to be the most difficult thing to do in Washington for some reason. There have been immigration policies before that were bipartisan that got close to the finish line, and then
I think there's more momentum at this point, especially when you
it'd
have,
be great.
like some sort of raid in a red state.
Yeah.
Yes.
Well, nobody wants the economy not to do well. And obviously, one of the benchmarks I think that the administration pays a lot of attention to is what's going on in the stock market. They're probably not paying as much attention to long-term rates as they should. The Federal Reserve doesn't control the 10-year Treasury bond, which underpins mortgage rates and a lot of the rates that the federal government, uses to borrow money. Although they're now Treasury Secretary is talking about only doing 90-day T-bills before rates come down to keep the interest costs down. But I'm kind of hopeful that works. And but the rest of the world is going to vote on what we're doing in our country on the basis of what those long-term bond rates are going to be, and it's going to be driven by their demand. And if they go up a lot, short-term rates can go down. The Fed can cut rates. But if that doesn't move the long-term rate, it doesn't help the economy very well.
Any further questions? Sure.
This delightful graph of housing prices
Mhm.
that keeps on climbing,
Yeah,
is it gonna keep on climbing?
no, it's flattening off. You can see like the very last
That little
few.
bit right there?
Yeah.
Already good.
Right. And anything that goes up like that, you have to wonder, you know, what goes up.
Right.
You
And
know,
this is
either comes down, or in the case of housing, rarely do you get steep declines, actual declines, but you can have periods that are flat for a very long time, just like you have in that chart. That data doesn't go back quite as far as the state level data, but if you look at it at the state level, you'll see there are periods where
Yep.
it'll be bouncing around close to zero or negative. And we're at a point now where real estate prices, you know, could flatline for a very long time, decline a little bit, be flat, because incomes are just not keeping up with it. And it's also a very thin sample because, you know, inventories have been low. People are holding on to their houses if they have low mortgages and not moving. And, yeah, but it makes people coming into the market are confronted with incredibly high price, anti-interest rate.
On page 42, I can't believe I'm saying page 42 of my report, but I actually have
Is that
NAR.
longer than usual?
Yeah, it's a little bit longer than you. There's a lot of crap going on there.
Yeah, there is.
I look at it, I track every month from the National Association of Realtors, the listed prices. The encouraging thing to me was there's a red number in terms of a year-over-year price change in listed values in Chittenden County for the first time in a long time. There are red numbers in 5 of 14 counties, which means that it's year over year. So, you know, there are all sorts of seasons. This is the season now and things like that. And the other interesting thing about Chittenden County is that there's 58.4% increase in the number of listed units over this time last year. So that's kind of helpful. That means that maybe something's kind of flattening out and things of that nature. And if you look, the other thing I do is I look over the last 8 years. And if we look in Chittenden County, the number of listed units is only down by 41%. The rest of the state's down by 2/3. So that's kind of like something that's saying to me, maybe the world isn't going to continue to go quite so crazy in the housing markets.
Well, supply will help.
Yes, supply helps.
Increase supply.
Absolutely.
I was at National Life this morning with a meeting with some of their executives, and there was a new executive there, like a year ago. Took him 11 months to find someplace to live, 11 months, and he finally found a copy.
Yeah.
Probably not what he was looking for.
That was it.
Within an hour's drive.
Yeah, but so the bottom table 9 is compared to 2017 and the other one is compared to
Yes.
previous years.
It's longer time period, and this is what
Yeah.
happened in the last year, just so you can.
Yeah.
And interesting, I mean, you know, the number of listed units is down 2/3 in Vermont relative to where it was back pre-pandemic in the 2017-18
The
period.
reason
So,
nobody's moving,
I mean,
anywhere to go.
well, I mean, you know, some people have locked in long-term mortgages at very low rates and don't want to move. And so the only things you're getting is when you have something happen in people's lives, or if they absolutely have to move to take a job or something like that, you don't see a lot of units moving.
Further questions? Well, I'd have for a motion to accept the state revenue estimates for fiscal year 26 and 27. Explaining item 3 and the meeting materials. Second. Great. Any other further discussion? All those in favor, signify by saying aye.
Aye.
Those opposed? The ayes have it. It's passed. And item 3. Thank you very much.
Thank you.
Yeah. We have agenda item number 4, the education fund outlook. And unless you have something, any questions or you would like to come up?
I will be back to the topic. I don't have any question.
Lucky there. Any other business to discuss?
I think that, for receiving various requests and various modes of requests, for folks who were sort of attentive to, what we put in the budget language, and just the various emergencies that come along with federal funding. So I imagine that we'll be having conversations about how we want to make those decisions, and, we might convene again in a couple weeks, either virtually or in person, to figure that out. But I don't feel prepared to, yeah, I don't feel prepared
Yes.
with any of those concerns today.
And I went back and looked with JFO this morning about the language that we put in there and the contingencies if we had funds to carry forward. And one of them had to do with money that was related to reduction in funds to the state. So some of the requests we're hearing are not requests that aren't state related. This it feels a little unprecedented that we're getting this. I mean, we're at unprecedented times, but even so, I think we can just how manage that and also go back to our language.
Yeah, we're not in any legislature in some respects here.
No,
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 thank goodness.
and defining emergency and all those kind of things.
On the education outlook, I just wanted to, it's not in our packet, but I'm looking at it, talking with Julia, that it's important that there is not the education surplus that there was in the last 2 years that we used to write on the property tax. And so that's going to be a major thing to keep our eye on next year. So I think it's important to look at that,
Yes.
and that it wasn't, we're going to have to pull from the stabilization. Yeah, right, based on the quote.
We have a lot to consider.
Yeah.
We'll have to keep our powder dry and revenues increase that we're seeing. We're up, it's probably money already spent.
Yeah, it's not anything.
But nothing.
Not really.
10 years ago, it would have been.
Yes. Many times.
They're taking motion to adjourn. Great. All those in favor, signify by saying aye. All those opposed, the ayes have it, we've adjourned. Thank you very much.
Thank you.